On June 24th, 1988, the New York Times ran a story that made history. On its front page, between an article about immigration from Mexico and one about how droughts in the Farm Belt were raising prices of cereal, mayonnaise, and spaghetti, there was a short piece with the headline reading, "Global warming has begun," expert tells Senate. The expert that journalist Philip Shabakoff was referring to was James Hansen. Several hours before the Times went to press, he testified to a room full of senators in Washington, D.C. Hansen was working at NASA, conducting research on the atmosphere of Venus. The planet is extremely hot, almost 500 Celsius degrees, and it's surrounded by a veil of sulfuric acids. Its temperatures are kept this high by a thick layer of carbon dioxide. Does this sound familiar? Exactly, the greenhouse effect. That's when Hansen decided to quit studying Venus and started approaching variations in the atmosphere here on Earth. Back in 1988, climate change wasn't a hot topic like it is today, but it wasn't completely new either. Two things, however, were really disruptive about Hansen's speech before the Senate. For one thing, Hansen was the first scientist to go to Capitol Hill and publicly state that human activities were causing global temperatures to rise. More specifically, burning fossil fuels was the cause. Even the 1990 Intergovernmental Panel on Climate Change report failed to recognize that, reaching the conclusion that climate changes were consistent with natural variability. Secondly, Hansen calculated that the Earth's temperatures would rise by 0.8 degrees between 1988 and 2017. It actually rose by 0.6. This means he was able to predict the almost exact warming that we have experienced 3 decades later, with a 20 to 30% margin of error due to factors he could not foresee. An outstanding and dramatic precision. I'm Jennifer Clark. I am a journalist, and I've always been passionate about great stories. This is a story that is 190 years old. It is the story of Generali and how it has always been a life partner for its clients, for global communities, and for those who are in need, with a spirit of constant innovation and sustainability. It's a story that comes a long way into the future. This is 190 Years of Future. Episode 5, A Red Heart with a Green Mind. Between that day, June 23, 1988, and today, a lot has happened. The Montreal Protocol, for instance, an international treaty designed to protect the ozone layer, helped us limit temperature rise. Other important attempts to halt global warming turned out to be less effective. The 1997 Kyoto Protocol is largely seen as a milestone for international climate policies, and it is, because it paved the way for the 2015 Paris Agreement, but it didn't really have the impact we hoped in terms of emission cuts. For a long time, the environment has not been a real priority for governments and companies, and this slowed down our fight against pollution. However, things are starting to change. People have become more aware of sustainability issues and are demanding concrete actions while also changing their everyday habits. Public and private institutions are embracing this call for a greener economy and are taking action. In a way, the pandemic has shown us that drastic changes in a short period of time are possible if they are perceived as urgent and compelling by everyone. This made me, and a lot of people, wonder what would happen if we approached the climate crisis with the same urgency as the global pandemic. It seems that we're going in that direction. If we look at how the economic crisis caused by the pandemic is being approached, compared to how governments reacted to the aftermath of the 2008 financial collapse, well, we'll see a big difference. In Europe, for instance, the Next Generation EU, the recovery program we talked about in the previous episode, lists a fair and quick transition to a green economy in its top priorities. Now it looks like words will really turn into realities and promises will be kept. The European Union has set some very ambitious targets for climate change and, more importantly, is putting governments and companies in a position to pay for it. Because converting our economy from fossil fuels to sustainable energy sources will be expensive. For a big picture view, we spoke to Simone Tagliapietra, who is a senior fellow at Brugel, a think tank in Brussels, as well as an adjunct professor at Università Cattolica del Sacro Cuore and at the Johns Hopkins University, SAIS, in Europe. Professor Tagliapietra, what is the impact of the EU's climate change targets in the Green Deal that was recently approved when combined with the spending plans in the Next Generation EU? Are we going to see more investment?
Well, I would say that what investors need to have in order to confidently invest into green technologies is long-term visibility and confidence that the decarbonization process will not be reversed and therefore will proceed as scheduled. The European Green Deal is about doing this. The European Green Deal, with the climate neutrality target by 2050 and a very strong emissions reduction target of at least 55% vis-à-vis 1990 levels by 2030, and accompanying policies to deliver on these targets, such as carbon pricing, for example, is exactly there to provide to investors the long-term visibility they need to invest today in green assets that, of course, will pay off over a long period of time.
Carbon pricing is considered to be one of the most effective strategies to reduce emissions. It is a very simple strategy as well. Basically, it's a cost that is applied to carbon pollution. It can take the form either of a carbon tax or a requirement to purchase permits to emit, generally known as carbon emissions trading or allowances.
Economists tend to think that carbon pricing is the most important policy tool to drive decarbonization because it allows to let polluters pay for their emissions and therefore internalize in the cost something that otherwise is an externality. Carbon pricing today in Europe, in the European trading system, which is the ETS, has reached these last months unprecedented levels of around 50-60 euros per ton of CO2. This is a clear cost that we are putting on polluters, and this is the most formidable signal we are giving to markets to invest in green technologies. The message is clear. If you don't invest in green technologies and you keep polluting, you will pay for this pollution and you will increasingly pay for this pollution.
So, 33 years after Hansen warned the U.S. government about the threat of global warming, we are now seeing the U.S. and the EU put the fight against climate change at the top of their agendas. Governments are important, but stopping global warming calls for changes on how companies do business, how people spend their money, and in our daily habits. Yet finance plays an important role here. To reach climate neutrality targets by 2050, what is the level of investment needed?
Well, the radical transformation of the global energy system required to achieve our climate neutrality targets by 2050 hinges on a big expansion in investments and a big shift in what capital is spent on. Today, average annual energy investments amount to $2 trillion per year, which corresponds more or less to 2.5% of global GDP. The International Energy Agency has recently estimated that the average annual investment required to reach net zero would actually need to go up to $5 trillion between 2020 and 2030, which would amount to 4.5% of global GDP. These investments most notably needs to target electricity generation, where we need to substantially scale up our investments from the current level of $500 billion per year to more than $1.5 trillion in 2030. In the meantime, we need to drop fossil fuel investments and, of course, keep investing in the other sources.
How can we achieve that?
Financing this large investment need involves basically two actions. On the one hand, we need to redirect existing capital towards clean energy technologies. On the other hand, we need to substantially increase the overall level of energy investment. The private sector is going to be fundamental with this regard. Companies and finance in general will be the ones delivering the bulk of these investments. And here it is important to stress the very particular role of long-term investors, such as insurance companies, in contributing to the financing of the green transition. Having long-term investment horizon, they are the perfect match for this kind of long-term green investments we need. Of course, governments also play a very important role. Governments have to stimulate private investments by putting in place a conducive regulatory framework and providing the right incentives for the private sector to invest. And it is important for governments to unleash the long-term investors in their financing of the green transition.
When it comes to long-term investors, insurers are very important. As one of Europe's largest insurers, Generali has about 600 billion euro in assets under management, which represent a sizable investment firepower. But it has also run a green financial management, which brings significant innovation among the European insurance panorama. The person who oversees the financial management is Cristiano Borean, Generali Group CFO. I met him and asked him how he sees the role of insurers and finance in general in the green transition.
Especially because I'm a finance person, I think we have a very clear understanding that if we don't change as an insurer and the head of finance into an insurance company, I can tell you that the effects will be devastating for the world. We see clearly in the natural catastrophes what is happening. Their frequencies and sometimes the intensity are increasing as well. So we are facing a situation where if we don't grasp a unique opportunity, which is this, let's hope, post-pandemic, when we can start using the word post in front of pandemic, word with the Next Generation EU, especially a fantastic investment that the European Commission is supporting all around Europe, could really help in making this transition. And the green transition and the transition towards a kind of zero carbon footprint is a super fundamental step which can create a lot of value out. So I strongly and fully believe that it is our duty, especially because we are insurers and so we care about our people, which are clients, our employees, and in general the society into which we operate, because if we just don't follow one of these important stakeholders, we will not get our purpose, which is to make people's life better.
The finance world talks a lot about green bonds, and globally these bond issues reached $269.5 billion by the end of last year, and could reach $400 to $450 billion this year, according to a report by the Climate Bonds Initiative. Generali was the first insurance company to issue a green bond in 2019. At the end of June, it was the first insurer to issue a sustainability bond and a catastrophe bond. How did Generali get started with green bonds and all the rest? It was because it already had some experience with revolving credit facilities linked to green criteria. These credit facilities basically protect an insurer from the risk of having a lack of cash. And moreover, many of the buildings in its very large real estate portfolio were already low energy consumption. And it wanted to invest further in this area. So from there, it was just a matter of taking the next step. I know these topics might sound complicated sometimes. Perhaps Cristiano Borean can help us understand or explain what a green bond is and what it does.
Green bonds are relatively new financial instruments, but they have experienced an extraordinary growth rate from 2007 until today. They are bonds like any other, but their issue is linked to projects that have a positive impact on the environment, such as energy efficiency, the production of energy from clean sources, the sustainable use of land, etc. So, for example, in our Generali Group Sustainability Bond Framework, the green eligibility criteria includes the green building, renewable energy, including electricity and heat production, energy efficiency, clean transportation, sustainable water management, recycling, reuse, and waste management. So the green bonds are important as they provide an opportunity to further enhance and accelerate the ability to finance the green projects.
Cristiano Borean mentioned the Sustainability Bond Framework. This framework is fundamental to make sure that green investments meet specific criteria so that they can qualify as green. Since this is a new area of expertise, companies and investors need to be sure that they are on the same page about definitions.
Indeed, the green bond governance and the sustainability framework around this is absolutely what we set up as a sustainability bond committee in order to issue, for example, our last sustainable bond a few weeks ago. The aim is to ensure compliance with the international best practices in the field of sustainability. So the Sustainability Bond Committee meets every 6 months, and it is chaired by the head of debt and treasury. So we need to integrate and reflect the sustainability criteria within the group investment process and as well do all of these 3 basic steps. The first one is the eligibility analysis, where each project is evaluated from the inception to understand whether it fulfills the eligibility criteria. Then there is the confirmation of the eligibility analysis criteria with a second analysis, and then the choice of the allocation of the identified asset. A fundamental part of the process is also represented by other 3 pillars of the sustainability bond framework, which are the use of the proceeds, the management of the proceeds, and the reporting around this.
As I pointed out earlier, green bonds are growing by leaps and bounds because they are part of a category of investments called ESG, or environmental, social, and governance. In the last few years, asset managers in charge of handling an investment portfolio are paying closer attention to whether a company's business is carbon neutral, for example, or if it exploits its workers. ESG funds captured $51.1 billion of net new money from investors in 2020, a record, and more than double the prior year, according to a study by Morningstar earlier this year. So now is the time for an insurer like Generali to get involved. I asked Cristiano Borean what sort of reaction Generali's green bond got in 2019. After all, it was the first insurer to issue one.
For the buyer, the clear importance of having green investment in the investment portfolio is a key strategic target. We do as well as Generali have a green investment target, and this is again consistent to the transition because it's a way also to support the transition towards the low impact energy economy. So on one side, there is a huge appetite for green or sustainable bond. On the other side, as an issuer, we benefit from 2 aspects. The number one is really being consistent with our strategy of putting sustainability at the heart of the functioning of the company. And second, yes, there was also a positive effect related to the pricing because there is a higher demand for this kind of asset.
To be specific, demand for the first Generali green bond in 2019 was over 3 times the 750 million euros in bonds that was being issued. For the second green bond in 2020 for 600 million euros, demand exceeded the amount issued by 7 times. So these numbers demonstrate the growing demand for investments linked to the energy transition. In this light, how does finance, the energy transmission, and climate change fit into Generali's long-term strategy?
We are strongly focused in accelerating and fostering anything around the energetic transition. And this is why everything that is green, which is basically already the commitment for our real estate investment going on in the future to be at 0 impact on the environment, for more than tripling the investment in the renewable and in general in the green and sustainable framework part on the asset side. So we are really bringing the sustainability as an entangled concept in all the actions we are doing throughout the company, because there is no future, and we strongly believe that there will be no future for a group like Generali with 190 years without a very clear, deep and profound commitment into sustainability. As Generali, we would like to have a red heart with a green mind.
Over its 190-year history, Generali has continually innovated and adapted to keep up with the pace of change so it can meet the needs of the people it insures. And with its green bond and more climate change commitments to come, it is continuing to do just that. But if we want to cope with climate change, all of us face a very complex challenge. And this, a red heart and a green mind, is exactly what we need. You have been listening to 190 Years of Future, a podcast written by me, Jennifer Clark, and realized by Cora Media for Generali. Research by Antonella Serecchia, editorial supervision by Sara Poma for Cora Media, recording and sound design by Frigo Studio.